Imagine a company as like a growing plant that needs resources to flourish. Just as a plant needs water and sunlight, a company needs money to expand its operations, develop new products, or enter new markets. This money, when it comes from the owners of the company in exchange for a share of ownership, is called equity financing. Think of it as inviting partners to invest in your plant in exchange for a portion of its future fruits. Corporations, these larger and often publicly traded companies, primarily employ two main avenues to secure this crucial equity financing. These are issuing stock and utilizing retained earnings. Let's explore each of these methods. First, consider issuing stock. This is perhaps the most well-known way corporations raise equity. When a company issues stock, it's essentially selling pieces of itself to investors. Imagine a delicious pie representing the entire company. By issuing stock, the company slices the pie into smaller pieces, called shares, and offers these slices for sale to the public. People who buy these shares become shareholders or part owners of the company. They invest their money, providing the company with capital, and in return, they gain a stake in the company's future success. There are different types of stock issuance. The very first time a company offers its stock to the public is called an initial public offering, or IPO. This is a significant event, often generating considerable buzz and excitement. Think of it as the grand opening of a store. Before the IPO, the company's stock was privately held, perhaps by the founders and early investors. Going public through an IPO opens up ownership to a much wider audience, allowing the company to raise a substantial amount of capital. After a company is publicly traded, it can still issue more stock later on. This is known as a secondary offering. Imagine the company pie is growing larger, and to fund further expansion, it decides to create and sell more slices. Secondary offerings are used to raise additional funds for various reasons, such as funding acquisitions, paying down debt, or investing in new projects. Both IPO and secondary offerings are powerful tools that allow companies to access a vast pool of investors willing to contribute capital in exchange for ownership and the potential for future returns. The second major way corporations raise equity financing is through retained earnings. This method is more internal and relies on the company's own profitability. Retained earnings are essentially the profits a company has made over time that are not distributed to shareholders as dividends. Instead of paying out all the profits, the company chooses to keep a portion, or retain it, within the business. Think of it like this: if our plant from before grows and produces fruits, some of these fruits can be sold, and the money earned can be given back to the initial investors as dividends, like sharing the harvest. However, some of the earnings or fruits could be reinvested back into the plant itself. This reinvestment could be used to buy better soil, build a stronger trellis, or even acquire another small plant to expand the garden. Retained earnings work in the same way. They are profits that are plowed back into the company to fuel future growth, finance new projects, or strengthen the company's financial foundation. Retained earnings are a vital source of equity because they represent internally generated funds. This means the company is not relying on external investors each time it needs capital. By consistently generating profits and wisely reinvesting them, a company can steadily increase its equity base and fund its growth organically. It's like a plant growing stronger and taller over time, funded by its own internal energy and resources. In summary, corporations have two primary paths to raise equity financing: issuing stock and utilizing retained earnings. Issuing stock involves selling ownership stakes to external investors, while retained earnings involve reinvesting company profits back into the business. Both methods are crucial for companies to secure the necessary capital to grow, innovate, and thrive in the competitive business world. These strategies ensure that companies can access the resources they need, whether from the wider investment community or from their own successful operations, to fuel their journey and achieve their long-term goals.